Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at a couple of disclaimers I need to show you, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way in the box. And I'll try to answer them as we go, or at least after the webinar has finished. Okay, I'll just run through what we hope to get through in the next 30 minutes or so. We'll just check out how markets are trading currently. We'll then look at a couple of the major risk events over the last week or so. So we'll look at the RBA meeting, the RBNZ meeting, and the associated majors, as well as today's UK CPI data and yesterday's UK wage growth numbers, as well as looking at cable, so sterling against the dollar, before then previewing the main event, of course, which is today's US CPI inflation data. And we'll just check out a couple of graphics on that, and also then the DXY chart as well, which is the dollar index chart. Firstly, though, we'll just check out how markets are shaping up currently. The dollar kind of moving lower again, actually, after breaking down yesterday as well. We had cooler PPI data, that's producer price index data, which really buoyed expectations of the Fed beginning to cut rates in September, of course. We'll look at that shortly. Activity currencies, they remained the top gainers, really, among G10 currencies. The Aussie moving above its 200-day moving average, although certainly the Kiwi took a tumble today after the RBNZ more dovish than expected meeting, and we'll get to the details of that shortly. Oil, natural gas prices lower, really, and gold up and threatening its record highs. Interesting, we've had sort of geopolitical tensions at the start of the week, and they're slightly easing now with potentially meetings going forward, peace talks, etc. Scheduled potentially for tomorrow. Fixed income markets, recession fears have eased slightly. Markets really awaiting the CPI data, of course. Last week, I think, interesting, treasuries, US treasuries, they saw really significant change of sentiment. So initially rallying amid recession fears before then slumping as concerns over that US economic downturn kind of diminished. So money markets really reducing their bets on aggressive interest rate cuts from the Fed, now expecting just over 100 basis points. But of course, economic data will heavily influence this pricing as we go through the month. And even this week, of course. Equities, positive start to the week, and this is what we're getting to now, really, after certainly manic Monday last Monday. Who can forget that? S&P rising yesterday 1.6%, NASDAQ climbing 2.5%, so tech leading the rebound here, and the Dow, of course, also edging higher as well. Yes, it was that PPI data really fueled speculation, really, of a potential larger interest rate cut by the Fed in September. That really provided market reassurance about that, and we're on course to hit the 2% inflation target with the 0.2% gain in PPI. As I say, tech led the gains, Nvidia up over 6%, AMD up over 3%, Qualcomm increasing by 4%. And really the mega cap tech stocks as well looked good. Tesla up over 5%, Amazon up 2%. We want to get to the VIX, which obviously we were looking at last week, or hopefully everyone was looking at last week, simply because that's the Wall Street fear gauge. It is essentially a live index of how kind of a gauge of market sentiment, really. It's options out to 30 days on the S&P 500, near-term expirations, basically. And that, obviously, as you can see from this chart, really spiked higher last Monday on the 5th, You can see we got up above 60, which is comparative to some of the huge events in history, really, in market history at least, and even the close was relatively high. So you can just see how relatively compared to these big events where sort of markets sort of priced fear, if you like, and volatility really. We obviously had then the Nikkei, that huge fall down over 12.5, nearly 12.5%, 12.4% on the day last Monday. But then obviously we've had this big rebound since then. Lots of factors involved in that sort of perfect storm with the sell-off. Certainly the sort of hawkish pivot by the BOJ against the sort of relatively dovish pivot by the Fed. That sort of kicked things off slightly with the further unwind of the yen carry trade. We've been talking about that. Then obviously we had softer non-farm payroll data, really sparking sort of these fears around a slowdown in the economy, US economy, and then various other factors, AI profit taking. We had Warren Buffett and Berkshire Hathaway selling off some of their Apple stake, and really then this sort of high concentration in certain small sector of stocks, obviously the mega cap stocks, really with extreme positioning, and then momentum crowding, all with funds with the same trade and then wanting to exit very quickly. So that's kind of a synopsis of those market moves. Otherwise, we've had this big rebound, of course, and yes, a decent rebound in stocks for sure. If we just pull up the S&P 500 chart, first of all, you can see that big rebound from 51.19, the low on last Monday anyway, and now we're up to sort of 54.34, gone through the 100-day moving average, that gray line, through the halfway point of this decline, and we're up to close to the 50-day moving average at 54.51. That'll be initial resistance, along with the 61.8 retrace of this move at 54.59. Yeah, as I say, stocks moved higher yesterday, and initial resistance 54.59, 54.51, sorry, and then you've got that halfway point at 53.94. In the Nasdaq, we should have put on the, we can just sort of roughly put on the fib here, just roughly or so. You can see we moved through the 100-day moving average at 18,907. The halfway point is now at 19,176. And the next upside level after that around 19,600. That's the Nasdaq 100. And then for the Dow, we've got that big level in there, which is 40,000 or so. If we just look at the fib levels, near-term fib levels at least, roughly speaking, yeah, we're not up to the halfway point. That's a 39,945. You can see there, which is just below, obviously, the 40,000 level. And we've gone through the 38.2 fib level of this move at 39,609. Okay, let's move on now to last week's main events. First of all, we had the RBA meeting. Just want to double check you're seeing what I'm seeing, which you are, so that's good. The RBA meeting, yeah, last Tuesday, kept rates unchanged at that 12-year high at 4.35%, as expected, really, for a sixth straight meeting. The bank restated that it isn't, again, ruling anything in or out on policy as it waits for really sticky inflation to abate before really signaling any move towards joining its global peers, of course, in easing. They do aim to bring down consumer prices, of course, while holding on to those significant gains we've seen since the pandemic. Overall impression really given by Bullock, the governor, well, the statement at least was that inflation is not where she would like it to be, and it's also taking longer to tame. As I say, it's not ruling anything in or out still, and this was, of course, a Tuesday meeting just after the manic Monday, if you like, and the huge volatility we just talked about. So they haven't really changed their mind on potentially hiking rates or holding rates of course. The full statement really highlights some downside risks, certainly to inflation, but the net impression really is the RBA still more concerned about upside inflation risks than downside activity disappointments. And so kind of might not be the last gasp, for rate hike enthusiasts really, if we do get this stabilization in markets and then inflation still being sticky, actually highlighted by the RBA Governor Bullock as well a few days later, actually last Thursday, when she said she wouldn't hesitate to raise rates if needed. That's pretty much the RBA. You can see the big bounce and dip through that spike low from April at 63.62 last Monday. Huge spike lower, really telltale sort of long wick. So rejection of lower prices. 63.47 was the low there, and we've just moved relatively pretty strongly higher. Potentially we should move as the Aussie sticks with its sort of relatively hawkish stance compared certainly to potentially the Fed, and we'll obviously take stock of that view after the CPI data, of course. We've broken through the 100-day and 200-day moving average, sort of initial very small near-term resistance. That was at 65.97, 66.03, so 66 a level there. Halfway point, this is a longer term level actually of this move down. Halfway point is at 66.16. We were up through that, and then the 50-day mover is that blue line 66.37 with the next major fib level, which cap resistance. You can see cap the upside really acting as resistance previously, so that's at 66.76. Interesting level in the Aussie there. Kiwi dollar, let's move to that, and the RBNZ meeting today. Again, big bounce from those lows below 58.80, around 58.60 or so, 58.49 actually the low from last Monday. Decent rise, as we've said, in basically cyclical risk on currencies, if you like. Decent bounce higher, but then obviously the RBNZ cut rates by 25 basis points from moving the OCR rate down to 5.25 from 5.5%. Was a close call, certainly. Money markets had kind of priced it in, but really analyst consensus really favored a hold. So quite surprising really how much in a way the RBNZ has their focus really has shifted from inflation to growth, and especially given the bank's remit recently changed to targeting only inflation. The Kiwi has certainly tumbled. You can see down over 1%, so giving back yesterday's strong gains and sort of seeing resistance at the black line, which is the 200-day moving average at 60.82. You've also got the 50-day at 60.55, and then that fib level at which we should probably move a touch lower down to this level here, which is there. So fib level is 60.48, and we're just down below that now. Biggest issue really for the Kiwi wasn't probably necessarily the cut itself, because that was priced of sorts by money markets, really more the fact that Governor Orr said that a 50 basis point cut was discussed actually, and then updated rate projections, well, they're not too dovish, signaling around sort of 50 basis points of further reductions this year, but markets really leaning to the dovish side after that comment about a bigger rate cut being discussed, pricing in around 75 basis points for this year. That means probably a 50 basis point, well, it has to be a 50 basis point cut and then a 25 basis point cut at the next two meetings. So interesting move, interesting comments by Governor Orr really, and that has hit the Kiwi. I'm just checking levels really, which should stick in the minor fib level at 23.6, so that is at 59.72, may act as some support if we get to that level. Yeah, interesting. Kiwi or the RBNZ, of course, joining the rate cut cycle, certainly in line with other central banks, apart from the RBA at the moment. Okay, we'll just now move on to today's other main events, which has happened already, of course, which was UK CPI data. Hopefully you can get a handle on all the figures that came out, certainly. Before that, we did have, of course, yesterday's jobs data. Kind of mixed report, wage growth moderating to 5.4 from 5.7% in June. The unemployment rate surprisingly dropping, but kind of can ignore that, really. There's a lot of questions about data collection issues, really, and concerns about the low response rates that are being gotten in that data. So it's kind of being slightly disregarded by markets. Headline or wage growth is still sticky, really, and that is the issue for the Bank of England. And then there is the knowledge of a sizable upcoming public sector increase, actually due to recent wage negotiations averaging around 5.5%. So still sticky wage growth data. As for the CPI data, well, that ticked up the headline, but lower than expected, 2.2 against 2.3 expected. But that is below the Bank of England's NPR forecast for Q3 CPI. Upside really driven by base effects from utility price adjustments in 2023, which saw a much more sizable reduction than the cut announced in July 2024. Core print, more important for policymakers, that was lower than expected at 3.3%. I'm pretty sure, just double checking that actually. Yeah, 3.3% against 3.4% expected. And then the key services number, really, that has been a focus for the MPC. That moderated to 5.2% versus 5.5% expected. And the MPC's forecast of 5.6%. That was, though, and again, possibly might be disregarded by the MPC, because we saw a sticky number last time around due to a spike in hotel prices, kind of the Taylor Swift effect in June, but then that sharp spike has been sharply reversed actually now. So potentially might be looked through this data again. This services bumped down. Because there is a fair bit of noise in that for the MPC to take the sort of couple of months readings out of that. Certainly, though, all adds to the debate, certainly among the 5 on the MPC who voted for a cut, particularly for some of the members of that group for whom the decision was finally balanced, of course, due to the assessment that inflationary persistence has not yet conclusively dissipated and there remain some upside risks to the outlook. That was from the MPC statement at the last meeting when they cut rates. So just a sort of possible hint that they may go slow in their policy easing cycle, I guess. Rate cut odds, they did sort of slightly increase for the September meeting, touched around 40%, now just below that, I think. Of another 25 basis point cut in September, fully priced for November, though. The issue really still being that core inflation is still well above the 2% mark. Yeah, we still get this sort of noise in services inflation, so they still might want to see more data to get more confidence, certainly. Here's a chart just before those numbers, where we were just before today's numbers, at least. You can see that falling headline number, but that ticked up now and is expected actually going forward to tick up slightly towards 3% in the next few months, basically as base effects kick in. And the big drop in energy prices that we saw in 2023, they fade essentially. Before then, CPI headline anyway, meant to drop back towards 2% in 2026. But key number will be services inflation, that 5.7 number dropping to 5.2, but a lot of noise, as I've said, around that. If we just look at cable, which is here, you can see we just tapped, the fib level at 128.65. We've got the next fib level at 127.57, and we've got the 50-day moving average at 127.87. It has bounced back slightly though, cable, from the low earlier on this morning. That was at 128.13. Prices were around 128.59 before the CPI data, so just a tick lower, with the dollar lower as well, that you can see. Okay, let's just get to today's main event then as well, which is of course US CPI data. Here's a preview with all the main numbers. After really June's downside surprise, really, consensus expects headline CPI to hold steady at 3%. That means a 0.2% monthly increase versus the negative print last time around. Core CPI, that's the main number, and the main number being the monthly number, that's expected to rise 0.2% up from 0.1% previously. That means the annual rate easing to 3.2% from 3.3% previously. Could be upside risks due to the pickup in core services inflation and energy prices, and then the core services ex rent and OER, so that's owner's equivalent rent, that edged down in June on the decline in airfares, but in July the decline in airfares likely to be much more moderate. That's where we are currently with those numbers. Then should the July CPI sort of print in line with expectations, then the Fed is likely to certainly start cutting rates. It just depends whether they cut rates by 25 basis points or 50 basis points. At the moment, that is around a coin toss. I think it's just come off the 55% mark in favor of a 50 basis point cut. Now just above 50%. So pretty much a coin toss for a 25 or a 50 basis point rate cut in September. Certainly this data will have a big sway on that in the near term. There is around over 100 basis points now of rate reductions this year. That's well up from obviously before Manic Monday and non-farm payrolls as well. If we just look at the chart, you can see some of these prices falling, of course, and the key number, PCE data, really key, the core number in line with the month-on-month reading anyway, 0.2%, which is in line with bringing inflation back to 2%. As for the reading, an inline print you kind of think would be the markets would welcome that stability in a way. So you could see mild risk on and the dollar mildly risk off. The dollar off. Certainly, though, if we get a shock sort of upside print, really that would not be great for the Fed. We'd pare back that amount of rate cut expectations, certainly. And the probability of a US recession depends how big the upside print is, of course, whether then recession threats go into stagflation fears. If the number is very hot, then that could be an issue. Downside surprise, certainly then we price in a 50 basis point rate cut. Those odds move from 50-50, of course, towards 70%, which is generally the benchmark, the threshold number where the Fed doesn't like to surprise. That's the CPI data then. Otherwise, we do get as well consumer data on tomorrow, actually retail sales. That'll be interesting because obviously gives us a handle on how fast the economy potentially is slowing or not. We do get Walmart figures as well out on their latest earnings out tomorrow as well. We get initial jobless claims, of course, a weekly number worth watching possibly. But retail sales are seen rising 0.3 from previous flat reading. And then the control group was seen, well, down slightly from 0.9 to 0.1%. Certainly the labour market is showing more signs of cooling, but for now, kind of wages and salary growth remain relatively supportive of consumer spending. Economists note actually increased price sensitivity though, which may be diminishing due to diminishing saving buffers, actually even allowing for inflation. If we just look at then the DXY chart just to finish up, you can see that here. So we just broke down yesterday, pretty much a bearish consolidation after that dip down. You can see trading around 103, got up to the halfway point at 103.56 and then came off that. So moving down towards this spike low at 102.16 and then potentially 102, I guess the big figure. And interesting, that spike low from March is at 102.35. So we're approaching that shortly. Okay, I think we'll wrap it up there actually. Thank you so much for taking the time to listen to the webinar. A lot going on, of course, and the US CPI data key, really instrumental for policy decision making with the September Fed on the 18th of September. We do get, of course, in the run up to that, the Jackson Hole conference next week on the 22nd. So potentially if this data is in line or softer, then potentially Jerome Powell may set up a preparation for a 50 basis point cut, because we haven't really heard from any other Fed officials talking about that. We do then get the US PCE data on the 30th, before then non-farm payrolls on the 6th, and then another US CPI print on the 11th, which is the week before the Fed. Okay, take care out there, and we will speak to you in a couple of weeks.